Hi everyone, Laura Jewett here with the Inspired Living Real Estate Collective. I am so excited. So I recently became certified as a loan assumption specialist, which, when I bring that up to clients or friends, they just kind of give me a blank stare and look at me like they have no idea what I'm talking about. So I thought that it'd be a perfect opportunity. I have a loan assumption guru here with Yumi Home Loans, and I want to just pick your brain on everything loan assumptions so that we can just kind of demystify what this loan assumptions is.
I like that, demystify.
Yes.
Right? Yes. There's so much bad information out there.
Yes.
So what do you think is going to demystify assumptions?
Well, I think for starters, what is it? I mean, because I literally get that blank stare of
what's an assumption?
I feel like I should know what this is, but I don't, so I don't want to say anything. So yes, just in a nutshell, what is?
Kind of like the Bigfoot out there. Everybody's heard of it, but nobody's actually ever seen it, right? Whenever I describe assumptions, the first thing for those people that have heard a little bit about assumptions, some of them think that they're that whole subject to realm, which is, for example, if you're like a listing agent or something like that, it's like the first 8 phone calls you get that are I call them TikTok investors TikTok investor sees something on TikTok. Hey, I can just call up this person and ask to assume their loan, and then I'll just take over the payments and I get it for nothing. And
next week it's all done.
Right. Next week I made $1 million and I'm done. Right. And I sell all the properties. But that's the whole subject to wrap realm. No. So what we always talk about from what I call a true assumption are government mandated. They're actually by law assumptions. And what that means is, so FHA, VA, and USDA loans. If you have a seller that wants to allow their loan to be assumable, and you have a buyer that wants to assume that, a qualified buyer that wants to assume that loan, a servicer, which is the seller's current mortgage company, a servicer has to allow that by law. They can't say no. So, and the key difference between that whole subject to world and the real assumption world is the release of liability. So what that means is the seller comes off the loan and the buyer goes onto the loan. So it's now the buyer's loan.
Right. Which is different than what a lot of the investors come in and try and do, where they're just, okay, that makes sense. So you did say a couple of things in there that I want to touch on. So the buyer does still need to qualify. There's still a qualification process. They can't just, have, horrible credit and, be working side jobs and expect to still qualify for this, for a loan assumption. So there still is a qualification process.
Incredibly, prior to 1989, you didn't have to do that. You literally could just have side jobs and sign on the dotted line and it's yours. But it's not like that anymore. But you have to qualify now.
Okay. And so what does that process look like? If a buyer was interested in going down this road or kind of exploring this option, what does that process of qualifying look like?
So from a process perspective, it's identical as if you're going to apply for, say, new financing.
Okay.
So you take a loan application, whether that's online, in person, whatever, you're more comfortable with. You do the loan application, you send in your income documentation, pull credit, and then you see what you can qualify for. But the difference is we have to then take all that information and we re-underwrite it to assumption guidelines, because there's a big difference between new financing guidelines and assumption guidelines. So we have all the info. Sometimes you need some extra documentation, because sometimes with new financing, you can get limited documentation. But with a little extra documentation, we get you pre-screened for an assumption.
Okay. And then at that point, shopping for an assumable loan is a lot different, kind of a different process than shopping for a typical, just any home on the market. So tell us what that looks like and what kind of platform you guys have developed to kind of ease that process a little bit more and identify those maybe eligible properties.
Sure. So the big difference between, say, the new financing world and the assumption world as far as shopping goes is in the new financing world, you talk to a lender and they say, okay, hey, Laura, you're qualified for $500,000. Go out and find a $500,000 house or whatever that is. In the assumption world, it doesn't work like that, because in the new finance world, they're basing that off of today's interest rates, whether it's 6, 7, 8%, whatever that number is. In the assumption world, all the loans have all different interest rates. So it doesn't work that way. You can't say a $500,000 house. What you get qualified for is a payment. So I'd be like, all right, Laura, you're qualified for a $4,000 payment. Again, whatever that is. And with the amount of money that you have down, you're going to say, I have this amount of money down and I'm looking for this payment. And then you shop in the assumption world that way. Actually, the place that you can shop for all those, if you go to Assume with Laura, you can go on there, you can shop for all the different assumable homes. You can see what the payments are, how much money you have to come in with. And it's all of the loans on the market right now that are assumable.
So explain to us a little bit more too about how that down payment is determined, because again, it's a little bit different than the normal process.
Yeah, way different. So again, new financing world, people are used to VA loans 0 down, FHA 3.5% down, conventional 5, 10, 20, whatever it is, 25% down. It doesn't work like that in the assumable world. The way that the down payments work in the assumable world is it's literally just the sales price minus whatever that loan amount is that's being assumed. So for example, if it's a $500,000 sales price and a $400,000 loan amount, that's a delta of $100,000. That means the down payment is $100,000.
Right. And so there are, some other kind of creative solutions to bridge that gap if you just say don't have that 100,000, getting a partial seller carryback or getting a small secondary loan or finding family or friends that might be willing to contribute towards your goals of home ownership.
Right, exactly. Yep.
So I think that's a good thing to point out that, there are creative solutions to kind of bridge those gaps or to make it a more feasible option for people.
Absolutely. We just had one, this is actually this past week. So I had parents that we're not giving it to, we're not gifting.
Yes.
There's no gift letter involved here. They're like, we're going to lend it to them. So what they did is they created a second mortgage for the purchase. So they acted as the bank. So they put a note, a deed of trust on there, and that was the secondary financing for their kids.
So you have a little bit more flexibility with those types of things versus on a traditional loan. It'd be a little bit tougher to, if you had a traditional mortgage and then you're throwing parents on
right? A little more criteria there, yeah.
As a second. So, okay, that's very, very good information to have. The thought of being able to assume somebody's 2.5% interest rate loan or 3% interest rate loan, I think is mind blowing for some people.
It is.
What are the catches?
So the big catch for a lot of people is the down payment portion. So if you have that down payment portion, the reality from a buyer perspective, there's not really any catches because it becomes your loan and it's your interest rate. Now you take over that loan from the day you take it over. So what that means is you're not getting a brand new 30-year loan or anything like that. So if someone's had a loan for 3 years already, they've already paid 3 years of interest.
And the interest typically is you're paying more interest at the beginning of a loan, front loaded. Yes. So there's that advantage too if all of that interest has been paid for you.
It's just a huge advantage. And now we're doing it sounds too good to be true, right?
Yes, I was going to say, we're supposed
going the wrong direction there. But no, so as far as catches, you've got, the reality is it's just the usually larger down payments because with the lower interest rates, it usually means they got that loan, probably the 2020, 2021 range, which means they've gotten appreciation in the house, which means there's going to be a larger delta there.
The process could take a little bit longer.
Yeah, of course. Yeah, the process is a little bit longer. So whenever we talk about, say, for example, sellers, on the selling side, the advantages are that, again, we're going advantages again. My bad. The advantages
there are more advantages than disadvantages. But
so we talk about, I always say you can sell your home quicker and usually for more money, but the reality is you can get it under contract quicker because it is a longer process and it is a bumpier process to go through an assumption. And one of the reasons is the servicers that whenever I say servicer, it's the seller's current mortgage company. But the servicers, a lot of them just aren't staffed for this. They did not see this wave coming. And they lose money on every single one of these that they do, so they don't want to staff and they don't want to do these.
So even though they're legally liable to do them, they're coming up with excuses why they can't or don't or won't do them. And then you have to show them why that's not okay.
Exactly.
So it's just kind of, I know you guys are forging a lot of relationships in this industry and with a lot of these servicers that is making the process easier, which is huge because you guys are so integrated into this assumption world. So that's a huge benefit too, which again brings me to the point of what is your role in this whole process and why is it so important to have your expertise involved?
So we have a kind of multiple roles there. One's just to facilitate the whole thing, to take care of all the tedious paperwork and all of that type of thing. But the expertise comes in, especially when you have a servicer that gives reasons why you can't do this loan. A very common one is, sorry, Laura, I know you want to sell your house, but it's not assumable to an investor. So that investor can't take over your loan. And then if you're just a normal
average
homeowner,
okay.
Shoot,
darn.
It's not assumable, deal fell apart, right? But they're not allowed to do that. And some of them know that. Some of the servicers know that they're not allowed to do it, but they do it anyway. It's like an insurance company, right?
Yeah.
So they're just like, no.
See what they can get away with.
Exactly. And most people will give up because they don't know any better. And that's where we have to kind of nudge them and remind them that they have to do it. And then if they tell us no, then we have VA remind them that they have to do it.
Relationships and that expertise and that knowledge base that just allows a much higher success rate.
Right.
And getting these pushed through.
Exactly. We just had one of those just recently. There was a servicer that sent an email to the seller. I'm sorry, it was an actual letter. They sent a letter to the seller that says, sorry, we have to deny this assumption because an investor is assuming your loan. And so the seller freaks out. I thought, and
You told me.
Right, you told me. And so the listing agent was like, I bet this is part of your process, like kind of almost sarcastically. And I'm like, it is. Like, this happens all the time, and we will push through this easily. And we actually closed on that one, I think it was 2-3 days ago. So it is just part of the process, having to deal with denials, because we deal with it all the time.
Which I think, let's circle back. Well, we still need to get to, maybe some of the challenges of
Right.
of this, but you had touched on, sellers, and why would sellers want to have their loan assumed? And I think it's important to note that a person's loan has value.
Mm-hmm.
So I think if you can speak to a little bit about, what that, why it's important for a seller to maybe keep this in mind as a viable option for increasing
Right.
their marketability, and potentially, getting more than, what they intended to receive on the home.
Yeah, no, so that's a great point. So from seller perspective, even just saying that you have an assumable loan, it gets eyeballs. It gets eyeballs. It gets buyers looking at the house, because not all assumptions are created equal. So if you have a really low interest rate and a low delta, there's a high value to that.
Value.
Those are selling, literally, we're seeing those sell in hours, if not a couple of days.
Probably with multiple offers.
Multiple offers. Yeah, we've had one that was like, 13 offers. It got boiled down to 11, and then there was a highest and best between 4 different people. And the difference in the seller, actually, to kind of illustrate some of the value, the seller said, I want a highest and best for a conventional 30-day close. And then I also want a highest and best for getting the 2.375% interest rate,
Right.
knowing that it's going to take probably another 60 days above that 30 days. And so 3 of those people didn't even give an offer for the regular conventional 30-day close. And the difference between only one person that gave that a conventional and an assumption, it was like $60,000 difference in the offer.
So there's no way to truly determine a specific, value of that loan and that interest rate but it's, 'cause it's going to differ, for every scenario and house and neighborhood,
Right.
and everything else, but it does have value. And
For sure.
Yeah.
We just can't quantify that. There's not enough market data to really put it like, oh, it's 7% better or 5%. Yeah, it doesn't work that way. But yeah, the higher value ones are definitely like low delta, low interest rate. Lots of value.
So you kind of mentioned that typically, you can expect that it's going to take, 2 to 3 times longer than an average closing. Is that about accurate?
Yes, for sure.
Okay, for the
For sure.
processing time. And again, depending on who the processor is and what kind of that relationship is or
Right.
whatnot. Okay.
So some servicers are a little bit longer and some are shorter, but they're getting better. We're helping them get more efficient.
Helping.
Yes, we're helping.
helping the industry
Right.
improve themselves. Yeah. So any other, again, I mean, I think so I guess the big elephant in the room is with the VA, the VA entitlement.
Entitlement. That's always the elephant in the room.
So I'd say that's probably the biggest challenge when it comes to assuming a VA loan.
So that's it's the most confusing piece. And that's really the only confusing, difficult piece in the entire assumption process, I'd say, is VA entitlement. How does that work? And how does that affect a veteran that's letting someone assume their loan that is not another veteran? So the way that works, if you think of entitlement, let's think of actually VA home loan benefits. Let's break that down. So you've got VA home loan benefits that are broken up into 2 pieces. One's eligibility and one's entitlement. Okay. So if you think of that almost like a credit card, the eligibility is yes or no, they're approved for a VA loan.
Right.
And the entitlement is basically that credit line. How much are they approved for is kind of how that works. So your basic entitlement, you've got unlimited entitlement. That means whatever you can qualify for, whatever you can credit and income qualify for. So it could be a $4 million VA loan, which we've run into. But what happens is if you allow someone to encumber your loan, which means just tie it up, which means it's still on your record, then you don't have full basic entitlement. You have what's called bonus entitlement. And so we have calculators for that. You have the access to that. So that's where you have to sit down with a veteran seller and really find out what their plans are moving forward. Because most of the time a seller is just thinking, I want to sell my house. I just want to sell my house and then I'll deal with all this later. I know I'm going to move, but if you can get them to think about what does that financing look like down the road, they can make a fully educated decision on whether they want to allow their entitlement to become encumbered.
That entitlement becomes encumbered for the duration of however long that next, whoever assumes it,
Exactly.
keeps that loan. So it's as long as that loan is alive and living, it
is encumbered the full amount.
Yes,
Exactly.
unavailable
Basically took up part of their
right.
credit line is the
But
way to think about it.
If they do that, new buyer
Sells a house.
sells a house, refinances it,
Yep.
whatever else, and that does become back eligible to
Exactly.
the veteran.
Yeah, then it goes right back to their entitlement. So they don't lose their benefits by any means. People think that they lose it or you can only have one VA loan, which it just isn't the case.
Assuming that, this is a little bit more of a challenge, as process-wise, or people are in a time crunch to be able to get into a property or those types of things, obviously that creates, could create some barriers to pursuing an assumable loan.
Very PC way of saying that, yes.
The approach we always take is, to get qualified, see what you can qualify for on, whatever today's interest rates are, what that looks like, and then alongside of it, that we're also pursuing any opportunities in the assumable world.
Exactly.
So, I think where the challenge comes is sometimes you look at these properties that, you can assume or that may be eligible for an assumption, and they're typically much, much nicer than maybe what you could qualify for just with the higher, current interest rates.
Right.
So that's always something I think to keep in mind too, is like you have to keep a balance of, what the options are and how those differ, and not just get locked into one scenario. So,
yeah.
I've seen that with buyers before.
Like a lot of times with buyers, if they can a lot of buyers have a singular focus. Like, for example, they'll say, okay, I'm qualified. They think of the new financing. I'm qualified for $500,000. So I'm looking at a $500,000 house and the payment is X with new financing. And they say, oh, well, you know what? This has an assumable loan, so I can get that house for a lower payment. But sometimes if you just change their perspective, is they're qualified for this payment. So instead of getting that $500,000 house, look at this $750,000 house that's assumable in the school district that you want, in that neighborhood that you want.
Yeah, so it can work both ways.
Yeah, that's where you can pursue that.
Yeah.
And then they're not as worried about the time frame, or the countertops weren't as nice, and that they're in the school district and neighborhood that they want.
Yeah. Well, and then too, that interest rate, having that lower payment should allow you to possibly have a little bit more flexibility in your budget to maybe make those improvements. So I think the value of a loan assumption sometimes can outweigh maybe, some of the cosmetic conditions of the home.
Right, for sure.
So it's a fun new world. And so loan assumptions.
I don't know if I'd say fun.
Well,
no, I'm kidding.
But I'm always one that's glutton for punishment. So
right? Then it's very fun.
Yes. So I love a challenge. I love being able to exceed clients' expectations and presenting them with another opportunity to make their real estate dreams come true. So I think in that respect, it's very exciting for me, just as another tool in my tool belt. But just knowing that there are it's a different process. It's just a different mindset.
You said it earlier. The expectations portion, that's the key to this entire thing, is setting expectations well. So if everybody knows what to expect, and what they can expect is not knowing what to expect, right? And it goes super smooth.
Well, I think a big portion of that is aligning yourself with a team that knows what they're doing in this space. So, if you're watching this and you're saying, okay, I'm going to go pursue assumable loans, I see the ones that are available, I'm going to go do this. It takes an experienced title company, an experienced, a whole team of people to actually make these successful.
Right.
So I think that's an important aspect to know, that it's trust the experts.
And a certified assumption specialist, right?
Yes, absolutely. So stick with your team, and to get you through the process. Any other success, like a fun success story that you want to share with us?
So fun success stories. I mean, we've had numerous ones. One of my favorite is one of the reasons why we created the company. We always called it the bring back buyer, which is the buyer that was searching for houses, but then prices started going up, rates started going up, and they fell off completely. And they're just like, I'm going to stay a renter.
A lot of people are in that boat right now. It's discouraging. And I think that's, why, I guess too, assumable loans have been around forever. Yes.
Forever.
Yes. So, but nobody has heard about them in so long because the interest rates haven't dictated a need for them.
Right.
So that's the reason why it's kind of this resurgence. So, but it is, I'm like, it's, I think, very interesting, there's like, you're like, oh yeah, I've heard of assumable loans, but I don't really know. And so I think that's a good point of
they're back.
They're back, and there's, there is another alternative solution to these high interest rates.
To stop renting.
Yes.
Right?
To stop renting.
We've had a lot of that. where there was somebody who was looking at houses and they were qualified for like 360. Her name was Maria, actually. She was like one of my past clients from ages ago. She was qualified for 360 searching, and then rates started going up, 350, 310,
Ouch.
270, right?
Oh, what do you get for 270 in
Nothing.
the Valley now? No,
Nothing. And that was right. It was during that whole process where we started the company and we're becoming the experts. We're forging those relationships with the servicers. And then I was like, Maria, you know what? Take a look at this thing now. Go look at this house. So she ended up closing. It was January 24th was when she closed. So she closed on a $470,000 1-year-old house in Westgate for the same payment that would have been, I think it was $290,000.
Gosh, and you guys are
same down payment, same
hero.
It's great. I know, right? Yeah.
That's a good feeling.
She's our poster child now, right?
Absolutely. So yeah, that's huge. So just know that there are other options. And again, if the assumption isn't a feasible option for whatever reason, that there are other programs and grant programs and different things that you guys can assist with too. You're a full service lender and can kind of help no matter what the scenario or what the situation.
Right? We definitely can.
Yeah. So awesome.
Cool.
Thank you so much for your time.
Yeah,
Hopefully
great.
this has shed some light.